Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 22nd of October 2020. And today we're providing a much needed financial update, midweek financial update, albeit it's just past the midweek, as our systems unfortunately have been down for a few days due to a virus, and no, not a coronavirus, but the other type. And after many attempts, the system is now back up and running again. So our sincere apologies for the lack of a video over the course of the last 2 days. So without further ado, let's take a look at what's been happening with the markets as a whole. Okay, now there are 3 very short reports we wish to read to you from Reuters, one published yesterday and 2 today. Now they're only about 2 minutes long each, and then once we've read them, and we'll read them back to back, we wish to discuss them briefly, and then move on to take a closer look at what the markets and gold and silver prices are doing. These articles include issues concerning interest rates, markets, and gold and silver, and what Goldman Sachs is predicting the gold and silver prices to be by the end of this year and through next year. Reuters article dated 21st of October, 11:29 a.m. Where's the floor? Investors left guessing as Europe money market rates sink. A widely used benchmark for US short-term interest rates has dropped to record lows, joining its European peers in the latest sign that massive central bank stimulus has suppressed borrowing costs. The 3-month US dollar London interbank offered rate hit a record low at around 0.21% on Tuesday and held near those levels in London trade on Wednesday. It is down more than 100 basis points from highs hit in March at the peak of market volatility triggered by the coronavirus crisis. LIBOR is a global interest rate that forms the price reference embedded in derivative contracts and loans worth $400 trillion globally. There is a disconnect between the peak we saw in LIBOR in March and the record lows we're seeing now, said ING's senior rate strategist Antoine Bouvet. What is confounding us is that credit risk is being underpriced. Interbank lending rates should reflect some credit risk, but that has been suppressed by the weight of central bank stimulus, analysts said, a development that also been reflected in tighter corporate bond spreads this year. The transition in LIBOR rates to a new interest rate benchmark, secured overnight financing rate, or SOFR, we call it SOFR, but SOFR, may help explain the move down as one rate converges with another. And the move speaks to the bigger fall across money market rates in major economies, triggered by the pumping of cash into markets by central banks to offset the impact of the coronavirus shock, analysts said. Others noted that expectations for fiscal stimulus may also be in play. What you're now seeing in the US and Euro money markets is that we're in an environment of extremely low market liquidity, which is pushing rates low. There's no risk that we saw earlier this year, said Jan von Gerich, chief analyst at Nordea. Total Fed balance sheet assets have increased just over $7 trillion as bond purchases for quantitative easing approach $3.1 trillion, according to DD Securities. In Europe, a key money market rate, 3-month Euribor, has also fallen to record lows in recent weeks amid the abundant liquidity the European Central Bank has unleashed across the bloc's financial system. On Wednesday, this rate was fixed at minus 0.507%, within sight of a record low hit last week of minus 0.51. We're all left guessing what the floor in LIBOR and Euribor will be, said ING's Bouvet. Reuters article dated October 22nd at 7:03 a.m. GMT +1. Commodities headed for bull market in 2021 on inflation fears, stimulus. Goldman Sachs. A weaker US dollar, rising inflation, risks and demand driven by additional fiscal and monetary stimulus from major central banks will spur a bull market for commodities in 2021, Goldman Sachs said on Thursday. The bank forecast a return of 28% over a 12-month period on the S&P Goldman Sachs Commodity Index, with a 17.9% return for precious metals, 42.6% for energy, 5.5% for industrial metals, and a negative return of 0.8% for agriculture. Markets are now increasingly concerned about the return of inflation, the Wall Street Bank said. Expansionary fiscal and monetary policies in developed market economies continue to drive interest rates lower and create demand for hedging the tail risks of inflation, lifting demand for precious metals, Goldman Sachs said in a note. Goldman's forecast for gold prices at an average of $1,836 an ounce in 2020 and $2,300 an ounce in 2021. And experts expects silver prices to be at around $22 per ounce in 2020 and $30 per ounce next year. Spot gold was trading $1,915 per ounce by 0527 GMT, while silver was at $24.85 per ounce. We will see later on that these prices have changed just a little. Gold, widely viewed as a hedge against inflation and currency debasement, has gained 26% this year, benefiting from unprecedented global stimulus and near-zero interest rates. Non-energy commodities could see an immediate upside as the market balances tighten ahead of expectations on strong demand from China and weather-driven risks, the Goldman Sachs analyst said. The bank maintained a neutral view on commodities in the near term and overweight in the medium term. End of article. Reuters article dated October 22nd at 11:50 a.m. but updated 2 hours ago, which was 1916 GMT +1. Headline: Wall Street rises as hopes rise for US fiscal stimulus. Shares on Wall Street gained on Thursday in choppy trading as investors cheered the prospect of more fiscal stimulus to support a pandemic-damaged US economy, with more data pointing to a slow labour market recovery. Trading on Wall Street this week has been dictated by a flurry of reports related to progress in the stimulus talks. The CBOE Market Volatility Index rose for the 8th time in 9 sessions and was last up 2.8%. US House Speaker Nancy Pelosi reported progress in talks with the Trump administration for another round of financial aid and said legislation could be hammered out pretty soon. The market remains highly sensitive to a fiscal stimulus deal, said Rob Horwath, senior investment strategist at US Bank Wealth Management. What we're concerned about is the labour market as we move to the next couple of months. We get the roll off the stimulus and the labour market remains suspect. That's why we're looking for fiscal stimulus and the market is looking for fiscal stimulus, he added. Pelosi and Treasury Secretary Stephen Mnuchin have been negotiating a relief bill near the $2 trillion mark, as some opposed by Senate Republicans who've expressed concerns about the federal deficit. Also on Thursday, data showed the number of American filings for state unemployment benefits last week dropped more than expected to 787,000, but remained stubbornly high as support from fiscal stimulus faded. At 2:02 p.m. ET, the Dow Jones Industrial Average rose 164 points. The S&P gained 18 points, and the Nasdaq Composite added 26 points. Investors will monitor the final presidential debate on Thursday night, where Trump will take on Democratic challenger Joe Biden, who is ahead in the national polls. Meanwhile, about a fifth of S&P 500 companies have reported third-quarter results, of which 84.1% beat earnings estimates, according to IBS Refinitiv data. End of article. Okay, so we can see downward pressure on interest rates, and bond yields are still dipping, though benchmark interest rates at the moment have remained generally unchanged. That said, we can see that the dollar index has fallen below 93, quite an important level, though we suspect it will still oscillate around that figure, and currently is 92.93. From the articles we've read, Goldman Sachs is positive about gold and silver moving particularly into 2021. No, we're not likely to have $3,000 gold and $50 silver as we mentioned many months ago. And even a number of our subscribers believed we were going to have that this year. I appreciate we still have 2 months to go before the end of the year, but it's not going to happen. But short of something truly catastrophic happening, we are more likely to see prices broadly in the range that Goldman Sachs have predicted, or maybe ever so slightly higher for this year. The Dow is up 152 points, the S&P up 17 and the Nasdaq up 21, while UK and European markets closed relatively flat or in very minor negative territory. As we've seen in the article, an expectation of a stimulus package coming out is still just about keeping US equity markets buoyant. Gold so far is up on the week, albeit just $5 at $1,904, and silver is up some 52 cents, so it's performed much better and currently stands at $24.70. Both of them still operating within the range that we forecast on our weekly update published last Saturday. Now, we've already seen that jobless claims figures were quite good, and tomorrow we have the market manufacturing and services flash PMIs for October being announced. And these may have a little impact. But we suspect that the presidential debate, due to be held in a few hours' time, may potentially affect markets more tomorrow than perhaps the PMIs, unless, of course, the debate turns out to be an unexciting event. My understanding is, of course, that people will have their microphones turned off, and therefore perhaps we shall miss the regular interruptions from both sides that we experienced in the first presidential debate. Now, meanwhile, we are working on catch-up videos. As with our systems being down, we have fallen behind. So it's quite possible that between now and Sunday, we may actually manage to produce 5 or 6 videos over that period. So please do watch out for them. Meanwhile, if you have any comments to make or any views as to how you see the presidential debate progressing this evening and markets moving tomorrow, then please do share those thoughts. And thank you for listening. If you haven't already done so, please subscribe to the channel, pressing the bell sign so that you're notified of our videos as and when they are published. And because of the system failure, we've not been able to produce the Empires and Dynasty discussion we were due to have with Controversially Greg, but that will most certainly be published in the next day or two. Thank you once again. Until tomorrow. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.